Our next panel is dedicated to project finance and infrastructure investments. And for this panel we have Pilar Carvajo Lucena, Principal Investment and Fund Partnerships at Third Derivative. Welcome. Maximilian Zoller, Principal at HV Capital. Welcome. Mark Robinson, Finance Innovation Orchestrator at Climate-KIC. Welcome. And our moderator, Tyler Christie, Managing Director at Decarbonization Partners. Welcome to our stage. The stage is yours.
Great, thank you for having us, and thank you to the panel for joining. We're going to jump right in because we have a very short amount of time and want to have questions with you all. So I'll keep my introduction rather short. But we're in a really exciting time, what we're talking about here around capital formation and not just in equity formation. Say, as Bloomberg reported, about 1.8 trillion was raised and deployed in last year in 2023. Actually, equity was down. 84 billion was raised for startups in the climate and transition space, which was down about 30%, but debt was on the rise. Some of that's probably linked to interest rates stabilizing, starting to hopefully go down, we think. But nevertheless, we hope that is a continuing trend, of course. And we're starting to see clearly funds forming at really substantial sizes and some really impressive commitments from banks as well. BBVA being one, making a commitment to deploy about 4 billion euros over the coming years, which is impressive. And you see this, a factor across a lot of other banks as well. And then in funds, we'll talk about project finance funds and infrastructure funds. There's a amassing amount of dry powder at BlackRock, which I can speak about. We have 50 billion AUM in infrastructure funds. It's been announced we're acquiring Global Infrastructure Partners, which is 100 billion AUM. There, a significant focus of that is in energy transition. Apollo announced a fund of 50 billion that they'll contribute of investing into energy assets over the coming years. EQT just completed a 20 billion euro raise for Infra 6. Brookfield out raising Fund 2 in climate, another 20 billion. So capital is coming now. We will need more capital. You look at the trillions that are needed for the energy transition, but the trend of formation is really really unprecedented and really exciting. And then we're starting to see, which we'll talk about, the deals that are happening around some of that, which is exciting. And I'll name a few, that are related to project financing, which some are very close to some of the panelists. So NPAL raising $1 billion euro plus facility. Zoller just 2 days ago announced a $100 million facility for debt lending. BlackRock again invested 550 million in an infrastructure project in CCUS, which is the first and largest of its kind. Then you have some mega deals that happened in the last year that we've all, I'm sure, read about, like H2 Green Steel raising some 4 billion in debt or more, and Veracor, another raising over 600 million from Macquarie, an infrastructure fund, investing at equity level at our first gigafactory, which is an interesting development. Then additional 650 million euros in debt there. So, and EIB, EBRD, it's great to see in the last panel EIB present, very active. We see it a lot, which is great. So we're seeing governments come in. That's enabling more private capital come in, and I certainly hope that this continues. So with that intro, longer than I had intended, I wanted to kind of first kick off the panel for each of you to talk about what do you see as this trend. And what we'd like to do is kind of make this a bit practical around, what is this trend? How can we best understand it? And then for companies and investors, so what should you be doing at different stages? What's relevant for companies? How do you fit that? Who should you be talking to? And how do you go about that process? So why don't we start though with the trend? I'd love to hear, maybe starting with you, Pilar, ladies first. This trend that I've talked about more broadly, kind of from your perspective and all the research, the third derivative and things that you've been doing. How do you see this trend developing and forming over time? Yeah,
for sure. And maybe for context, so Third Derivative is an accelerator program for early stage startups that are addressing the hard to decarbonize sectors with technology innovation. And so I think it's relevant for that brief intro for the context of the conversation we're having here, because when we bring companies on board into our program, they are in like the pre-seed, seed, and sometimes Series A stages of development. But we've been operating now for 3 years, and now it's 15-20% of our portfolio is starting to reach those stages of scale-up and development that require different type of capital, different approach to bringing different stakeholders to the table. And we have identified, connected to the point that Tyler was making, a bit of a gap in terms of the skill set that some of these teams have by the time that they get to that, first of a kind or demonstration, pre-commercial scale level of development. And so one of the things that we've identified is teams lacking, the adequate skill set or resources, just because the industry traditionally has not been supporting founders in those particular skills when it comes to project development. But then also on the capital side, recognizing that, venture capital alone, it's only going to take startups so far, and we're going to be needing different sources of capital as well to support it. Is it in this context that from Third Derivative we've been working on a program to particularly focus on first of a kind or demonstration pre-commercial scale program to support founders that are getting to those stages of development, access the right type of skill set and the right type, I think one of the things that when it comes to project finance, for example, or infrastructure development, it is relevant to identify the right type of risk, making sure that you have the right, developer skill set, but then also the right capital partners. And so anyway, from our perspective, we've been developing this specific program for projects that are getting to that scale to really help them bridge that gap to the next stage of scale up. And, starting with industries such as chemical processes, when you think about green cement, green steel, thinking about, large scale clean tech development with long duration energy storage or CDR solutions. So those are some of the areas that we've started to focus on that front.
And Max, maybe you can comment next, having been both on the operator side, a couple of these companies I mentioned, and now on the investing side. How do you see this developing over time in your?
Yeah, I mean, it's interesting. On the solar side, obviously, a lot of the SPV and project finance has been going on for more than a decade already. So that's nothing new. And NPAL, which is one of our portfolio companies, obviously had large scale project financing ready already, but I think what has happened over the last 2 to 3 years is that there's a new wave of companies, just like you've mentioned, that is now around the Series A stage or seed stage, and is just starting to realize that they're not going to be able to get to where they need to be purely with venture capital. And for some of the founders, that's something they did not necessarily know before. So that's a new quality of both projects and teams that I don't think would have thought about project financing before, but it's badly needed because else they're not going to get to where they are. So rather than large scale decentralized assets, just the solar or heating systems, they can be big one-off projects in the chemistry space, or also smaller scale projects, but in any case along the entire variety of renewables, right? So I think that's something that's been happening over the last 2 to 3 years, and I think I totally agree with what you've said, that there's a lot of need to help and educate some of the founders, because if they rely on venture capital alone, then it's not going to work.
Mm-hmm.
Mark, switch to you.
Yeah, a similar story actually for me. It is very true that that the graduation from venture capital into project finance is a challenge, and of course, what we're facing in the company I've worked for at Climate-KIC is we're very much working on the demand side. So we work on relationships with governments, cities, and regions. We're working and leading the 100 cities in the net zeros projects, for instance. And we also have agreements with other governments around Europe, Ireland, Austria, Slovenia, and really capturing their needs are. And those needs are vast, and they require scaling up. And of course, we have a pipeline of over 1,000 startups that have graduated from our accelerator programs, but there's a need to bridge that gap between the venture capital and the project finance. So I'm right at this very moment working on the financial architecture to make that possible. And so it would seem to me to be a crucial involvement of a blended finance and a flexible financing fund. So we're talking to major European investors at early stages of discussions such as EIB, EIF and others, and looking to structure something that would enable a fund-of-funds approach to put in a flexible blended finance umbrella fund that can then provide finance to SPVs on a smaller project scale. So that's how we see ramping up deployment on a scale that can actually create transformational change rather than just incremental change on a project-by-project basis. So, but yeah, it's matching up what we have on the supply side with technical solutions to the mobilizing finance on the demand side, and we're getting there, but we don't have the answers yet, but this is something to look out for. So for companies that are interested in partnering on the finance or have the solutions that want to scale on a pan-European level, then please get in touch, because this is what we're working on right now.
That's exciting, and we'll come back to that in a little bit. This space obviously is quite vast, right? There's lots of different shapes and colors of infrastructure, project finance, and whatnot. And not everything is a perfect fit for every business, of course. And so one question for you, Pilar, is to help people think about this, and as you think about it, is really like, how should a team be thinking about what's relevant for their business model, and how that can really help them move beyond that or alongside that venture capital funding, and that can help then narrow down how they spend their time, which is the most precious resource, to get the right fit, rather than boiling the ocean in this space. So maybe a little bit talk about how they should think about the relevance to their business.
Yeah. It's a great question, and actually we do spend a lot of time with our founders thinking about some of the trade-offs along the way when you have to decide which partners to bring on board. And as an example, like, we do see companies that are getting to that demonstration, pre-commercial scale in our portfolio that need to decide whether they engage with, a corporate, for example, to speed up the process of scale-up, bridging for some of the know-how that they may not have in-house, but that the corporate can help bridge and take to that next level. Or thinking about non-dilutive funding, for example, and some of the trade-offs that comes with, engaging with grant governments that can provide a lot of capital without a dilutive effect into their cap table, but at the same time, it comes with some trade-offs when it comes to the speed of development with some of the verticals in the portfolio. And then also, I guess when it comes to project finance type of funding, we do see companies also engaging with developers and EPC contractors that are taking that initial risk to try to, build up the infrastructure, or like the baseline for then structured types of financing that are a little more similar to project finance, but I think similar to what Max was saying before. We're gonna have a transition period before we get to, where project finance is today for solar or wind, given that there are many risks that are specific to certain technologies when it comes to taking them to that demonstration stage. But then also when thinking about what offtake agreements look like, what's the profile of EPC contractors for the deployment of these projects, or even the risk associated to feedstock at scale when it comes to deploying these projects at larger scale when it comes to demonstration, or the pre-commercial level of development. So I think those are some of the considerations that I think will come into place. And I wish we had a little more, I think we're starting to develop that playbook of like, what are some of those key trade-offs, considerations, some strategic decisions, and who are the key hires along the way to make sure that, startups that have been historically been very technical do need to think about when to bring the right teammates to focus on the business development, to make sure that you're focusing on profitability and fundamentals, making sure that you know how to leverage capital efficiently as well. And all of that will require, decisions to be made along the way in terms of hiring, what are the right capital partners that you want to bring on board, and then what are the technical and commercial skills that you have to be developing over time.
Got it. Maybe switching to Mark for a second. Now, thinking about who should they be talking to, and these different institutions, from banks to public sector, blended finance, and whatnot, and maybe you can help a little bit opine on that, navigating that of who are the individuals, the roles, the institutions that are best for them to connect to.
Yeah, there's no easy answer to that, in all honesty, because there are a plethora of opportunities for receiving grant funding and development funding, and as we've mentioned, that is generally suited to the early stages of a project. But even a mature EPC contractor will be needing to compensate their development costs in a project, which is the most risky part for them. And I would urge people to think about, if you're that type of company, is to seek assistance from grants to assist with your development costs, because certainly in my experience, and I've done 15 years of developing project finance structures, and I know how hard it is, it's often the case that there are too many projects that you could go after, and it's selecting the right one. And finding corporate partners, you've mentioned, is another way of doing that, so that can take some of the capital risk. So for example, if you're a developer, is to look who's downstream of the project, like an EPC contractor, and joining with them, and not only will they potentially provide capital for you to develop projects, or put you on a success-only basis for if a project reaches fruition, they can also help you with some of the legal costs around structuring. And ultimately, they're the ones that are going to be delivering the project, so they would be aligned with the vision of the project, because they'd be taking the risk in succession to when you pass on the development of the project to the execution phase. So I think corporate partnerships are critical, and in Europe that's fine, but if you're looking in emerging markets, that can be a tricky thing. But the rewards are a lot greater in emerging markets. So yeah, I think that's it. It's looking for the right finance at the right cost, and looking for the right partners if you don't have the in-house experience already.
I like the partner comment. One thing, and often that ends up being a customer as well. One of our mantras at Decarb Partners is we look for the desperate customer, we call it. Usually that desperate customer is willing to finance and take risk in an unusual way because they need that supply to develop, they need that partner to mature, to get to the point where they can actually offtake that solution. So often it's like a customer-led financing that then helps unlock other parties to come in.
Very true. I would just like to add to that, because if you have a public sector client, then that can be very much the case, where they need to get something off the ground quickly and would rather allocate funding to a developer who can then deliver the project, rather than allocate funding to an engineering consultant who would just prepare a very often standard plan that would then stay on a shelf. They're looking, I've found with public sector, that they're willing to fund that upfront development cost. So you're de-risking the project by taking your designs to 80-90% complete, and then that is then even more attractive for the blend of finance that you need afterwards if you've done a really robust development process. So yeah, just to add to that, totally agree. And
hey, Max, you and I both worked in startups and know how crazy it is. Lots of different things going on, more priorities than you can count. And so, one of the questions to you is, and as you've seen probably the trajectory of some of your portfolio companies, like Svenpal, when is the right time to be allocating what type of resources to this big challenging adventure, which is often a whole new muscle, like you said, for companies that maybe didn't foresee this capital need for them?
Yeah, so I mean, generally, even though it sounds extreme, I would say you can't do it too early. I mean, not in order to be able to close a project finance, but if you know that you're going to need it somewhere down the road, be it starting with a grant or a corporate partner or later on a big project finance facility, I think it really pays off to talk early and often. Not necessarily from, not devoting like 20% of your time each week, but maybe like talk once a week or maybe twice a week to like a person not necessarily to already close a deal, but to establish a relationship beforehand, and most importantly, understand the mindset of the people that you're going to be working with, because in venture, we are embracing risk. We profit from the upside. It's an outlier business in the end, right? We have to invest in companies that can, return our fund, and we have to ideally have multiple of those. A classical project finance, developer infrastructure fund doesn't care about any of that. They're debt financed, right? Risk is not necessarily good for them. So that requires you to be entirely different, I think, much more. If I think about the classic business plans that I get and that I have to vet, I don't think that's a business plan you should be showing to a debt fund. You should be really thinking about, showing all the risks and having an honest conversation, which is not the way, conversations with VCs usually go, where it's much more about the upside. So just to, as I said, develop that muscle, I think you can't start too early.
Yeah, it's interesting. We're like right in the kind of midpoint of this, and so it's interesting when we had founders come to us, and it's on the VC side is thinking, the innovative, disruptive company, and then on the back of my head, I'm thinking, when you're going to go and talk to an infrastructure fund, they want it boring. It needs to be no disruption, no,
super established.
Yeah, and then you remember, and some of my colleagues in infrastructure funds, the core of that was like toll roads, right? It's pretty predictable how it's gonna function, how you're gonna make money. So it is a switch in that mentality, and then developing kind of a business plan that makes sense for that type of capital down the line. So we view like a trajectory towards being more boring over time is actually a very positive thing in a way. Well, thanks. We did want to do questions, and so maybe we can turn over to any questions. I know we don't have a huge audience here, but hopefully somebody will be bold. Any questions?
I would have a question regarding Hi. So my question would be the size to go. So we're actually looking at doing structured finance for building integrated solar roofs, which has its own challenge per se. But we feel that we are too small to go for €100 million SPV, and then we also feel that there's this gap to get to a sizable. Just a size where we can actually deploy a sensible amount of capital. And there's a lot of funds that say, hey, we'll look into this if you can deploy 50 or 100 million euro, but if we're talking about even 20 million euro, it's just too small. So what would you kind of advise, or what would you say about how to kind of get to that size? It's a little bit what you mentioned in the beginning, that there is this chasm to be crossed. Yeah. Thank you.
Can I take that, Max?
So I mean, there's probably no easy answer to this, but like you got to kiss a lot of frogs. I don't know, does that translate in English as well? Got to kiss a lot of frogs to find the prince. And there's a lot of funds who also so for example, one company I know, Solas Capital, they specialize up to 40 million project finance. I think starting as of 2 million. And so obviously they got different requirements for other stuff, but there's a lot of funds now, and I think we've seen the panel before, the project financing landscape is evolving. So I think there's no clear-cut answer, but it requires to be out there and talk to a lot of people and listen. And for sure, VCs can play a role in financing the first couple of projects, and for sure we're doing that. But I think that's limited to probably first of a kind, first of a kind of financings, and not parts of it, I would say.
Yeah, questions? Anything else? Well, I think we're close to time. Any other comments from the panel? Or should we let everybody finish off their day?
Maybe the one comment I would make, that I think it's important on the capital provider side, and I don't think we talk enough about it. And we demand a lot of innovation from founders and from solutions to solve climate issues. I think we should also be a little bit to your point. I think there should be a lot more creativity on the funding side, and I think we are definitely heading in that direction. And you see, people kind of stepping out of their comfort zone, try to go the extra mile to, make ends meet when it comes to different capital structures. But I think we need to see more of that for the type of climate infrastructure deployment that will be required to meet the 2050 goals. So I think this is more of a call to action to everybody in the audience, but then also just like a mental note for all of us.
Great. Spot on. All right, thank you very much. All right, thank you, everybody.
Thanks.
All right, done?